Have you ever thought about how to unlock the value of a highly appreciated asset while deferring capital gains taxes and gaining more financial flexibility? If so, this episode is for you. Welcome to the Vital Wealth Strategies podcast. I'm your host, Patrick Lonergan, and today we're diving into an exciting conversation with Brett Swarts. Brett is the #1 best-selling author of Building a Capital Gains Tax Exit Plan, the host of Build It to Billions podcast, and an expert in helping entrepreneurs and investors navigate the complexities of deferred sales trusts. In this episode, we explored the strategies behind using a deferred sales trust to maximize financial growth by deferring the capital gains tax and truly living life on your terms. Whether that means building generational wealth, pursuing impactful investments, or living a laid-back, no shoes, no shirt, no problem lifestyle. By the end of this conversation, you'll have the tools and insights to decide if this innovative approach could be a game changer for your financial strategy. Let's dive in. Brett, you are an Amazon #1 best-selling author of Building a Capital Gains Tax Exit Plan, and also the host of Building It to Billions and Capital Gains Tax Solutions podcast. I'm excited about this because we have a number of clients that own very valuable businesses, and they're looking forward to an exit at some point. And I think the strategies that you talk about and help your clients employ is wonderful. So thank you for joining us here today.
Patrick, grateful to be here. Thanks for having me.
Yeah, very good. So I'm just wondering if you could get in and start to explain what a deferred sales trust is, how it works. Could we just start with the basics, and then we'll dig into we'll call it a little case study before we're done.
Yeah. So the deferred sales trust, the way I like to put it is that it helps to unlock what we call an irresistible capital gains tax exit plan. And irresistible for our clients, we have found that they want flexibility, they want diversification, and they want time. They want, what we call truly passive income. And these are some of the big kind of ideas that we work with. Now, like any strategy or any structuring or any product, if you will, service, it comes down to the experts to execute the service, right, in a way that is customized and it fits the goals and the risk tolerances and all the different things that are associated with that. But at the core of what the deferred sales trust is, it's a tax deferral capital gains tax strategy based upon IRC 453. Most of your listeners might know it as a seller carryback, where a seller can defer tax by deferring payments. In other words, they can become a creditor to a sale. And so we work with people that have, big business sales. They have large Bitcoin exits. We're recording this. We're close to 100,000 a coin today. Pretty incredible. And real estate are our main three that we work with. And people really want flexibility and be able to defer that tax and to be able to diversify with groups like yourself, Patrick, to balance out their financial wealth.
Yeah. Okay. So this is really interesting. You talked about it. We'll call it an installment sale, where the typically when I sell that way, right, I don't get all my cash up front. I have to wait until the dollars are sent to me. So can we talk a little bit about how this all works? And I don't necessarily want all my dollars up front. Especially if I get to spread the tax out, most of the time I'm looking at this windfall going, okay, I need to invest these dollars and utilize it in a particular way. I just don't want to leave the cash with the potential or with the buyer, because if they don't run the business very well, I might not get all my money. So can you talk us through how we combine this idea of a lump sum of cash and the installment sale together?
Yeah. So what you nailed it, the old school installment sale. What's the old school one? I call it the blockbuster installment sale, when you have to finance the buyer. And why is that not great for you as the seller? Well, let's imagine you owned a business for 5, 10, 15, 20 years. This is your entire, life's work, if you will, career work. It's a big sale. It's, the legacy and the financial futures on the line here. And you want to retire and or do something different. The worst thing that could happen is you sell it for what you call a good price, make a good deal, but you finance it. And then 2 years later, the buyer has run the business or the real estate into the ground, and you're having to pick up the pieces. And just when you're getting what we call truly passive income, you're now having to jump back in and start the career or pick it all back up. And so that's why a lot of sellers are hesitant to finance a buyer, but they understand the concept of if I delay receiving payments, I can delay my tax. And so a good way to think about this is like a delayed tax trust. It's kind of like an IRA or a 401k. Here's the difference though. We eliminate all of that negativity in the sense of we de-risk in fact, we eliminate the foreclosure on the old buyer or the old business. And here's how: we have a trust jump in right in between seller and buyer and do it like a simultaneous close. It'll buy from you, Patrick, if you were the seller, and turn around immediately and sell it to the buyer. And so the trust itself bought and sold for the same price. We're not going to finance the buyer at all, right? They need to come with all cash or get a loan from somewhere else, but you will finance the trust and the trust will owe you back the money. And this is where the magic opens up, because now they can put it into a diversified portfolio of liquid investments or businesses or real estate or a mixture of all the above. And it can be secured against the biggest companies in the world, right? And wow, all of a sudden my collateral is some of the biggest companies in the world versus the business, which I'm sure was a great business and did well, and you're comfortable with that. But do you really want to foreclose on it if the buyer doesn't actually perform?
Yeah. All right. I love this. So let's step back for a second and just talk about the tax. So let's say I have a $5 million sale. Okay. I think the first tax we think about is the federal capital gains tax. So I live in Iowa. I start off and I pay that federal capital gains. So at 20%, there's $1 million that just goes out to the IRS out of my $5 million dollar bucket, right? And then we start layering on state of Iowa. I pay ordinary income tax on those dollars that come in. So I think we're at 5.7% this year. So there's another $250,000 that are going out the door. And then we also have I'm going to call it the Medicare surtax, which I think is it 3.9, 2.9, 3.8. Thank you. That also needs to come off the list. So it's like, before I know it, I've got a third of my proceeds have just gone to tax. Is my math about right there?
Yeah, you nailed it, right? And that's the brutal part, right? I mean, in fact, what Iowans and all the other Americans, baby boomers, are facing is what's called the largest wealth transfer in the history of the planet. It's about $84 trillion, and it's tied to mostly high-end primary homes, businesses, and commercial real estate. It's 50% of all the net worth in America, and there's about 10,000 baby boomers turning 65 every single day, and there's about 80 million in the U.S. alone. And so they're facing this exact scenario. They've built up this wealth, and now they're looking at, 20, 30, 40, 50% of their proceeds being crushed by capital gains tax. And I say proceeds because sometimes these sellers have debt on these assets, right? And they might be selling something for, let's say, 5 million, but they have, let's say, a million or two of debt. And so after paying the tax, they go, well, why would I even sell? And they end up just having to feel like you have to keep working and keep going. And so we want to unlock time freedom, and what we call truly passive income, by being able to sell and move on to the next chapter of your life, to whatever that means for you, making more of an impact, spending more time with your family, building the mission, vision, values for your family in a very intentional way. But until you can unlock a lot of what's holding you back and get past that barrier of that capital gains tax, a lot of people feel trapped.
Yeah, I love it. So if I'm going to use some round numbers, and just to get a little better understanding of how the deferred sales trust works in my favor. So if I have a $5 million exit, and I get to move all $5 million into the deferred sales trust, and let's just pretend for a second that I earn 5% on that portfolio. Okay, that's my interest. I assume I get that distribution out to me, and I pay the income on the income tax on that distribution. Is that a fair statement?
Yeah, as you receive payments back from the trust, if you receive just interest at 5%, let's say that's what you're receiving, and the note is written at, let's say, 5%, although we have notes written at 6, 7, 8, and 9, and sometimes 10%. But let's imagine it was written at 5% and it just made 5%, and you receive 5%. and we say that 5% is net of fees, but just keep that simple. Yeah, you would just pay a tax. You get a 1099 for $250,000, and you just pay tax on that.
Hmm. Yep. Okay, great. Where if I compare those same dollar figures, if I have $3.5 million because I gave a third of it to the IRS, and I'm at that same 5%, now I'm getting $175,000. I took a $75,000 haircut every year because I decided to pay the tax up front versus move it into deferred sales trust. Is that a fair assessment of how, like, I get to earn on the total balance versus the lesser of the tax proceeds? Yeah. Okay. That is a beautiful thing. So now, can we talk a little bit about the principal? Okay, this capital gain that I've deferred. Can we talk about how that gets pushed out of the trust? Can I leave it in there forever? Is it something I have to take out over a period of time? Uh, what happens if my heirs inherit it? Can we start walking through some different scenarios with the capital that's left in the trust and what my options are with that?
Yep, quick question. So, some of the most common questions are this: like, how long does the DST? How long is it open for? How long does it last? Can I pass it to my kids? How does it work with my estate plan? What happens to the principal I receive it? Let's kind of go through a lot of this, right? So first of all, these are typically 10-year notes, and every 10 years you can renew for 10 years, and you can pass it to your kids, and they can continue to renew for 10 years. And you can basically go out for as long as you and your kids want to go to defer all of the principal, right, of the capital gains and a tax, right? So all the capital gains tax, all principal. And most clients in this scenario will keep the 5 million intact, and they'll just live off the cash flow. And so you can defer the capital gains tax for as long as you want, as long as you don't dip into the $5 million principal and you just live off the interest. And that's literally what 99% of our clients do. But let's imagine you do want some money to spend on something personal, like a primary home, or you want to buy a boat. And by the way, that interest that's coming out, you're gonna get taxed on it. You can spend it on whatever you want. But really, you only get taxed on the principal if you dip into the principal, right? And we can schedule a principal payment, and we can adjust the promissory note over time. And so it's not, you never set in stone for the payments. And then the kids themselves, you have multiple kids, they can step into your shoes and continue the tax deferral, not a stepped up basis, right? Just step into your shoes and continue the tax deferral. So let's say you had two kids, right? And you wanted to go 50-50, 125, from the payments. When you, and let's say you're married, you and your husband or wife die, boom, then they can step into your shoes, and then they can make the 125, or they can take their 2.5 million, just pay the tax on that. It kind of just depends what kind of, how you set up your living trust, and what kind of, terms and conditions you put inside of that.
I love it. So one of the things that you discussed earlier was I can go invest these proceeds into, I'm going to call it a stock and bond portfolio, right? Let's say I want to be in the S&P 500, diversify my risk, largest companies on the planet. Now, let's say that portfolio performs at 7, 8, 9%, exceeds my, I'll call it my note payment. Is there a payment like I can set up 5%, but if my portfolio performs at 8 or 9, what happens to the difference in those proceeds? And can we talk about it the other way too? So
Yeah, exactly.
yeah.
So to to make what's called to make the trust commercially reasonable and have some business purpose, the trust itself owes you the money, the 5 million, and if you wrote the note at 5%, it owes you that in net of fees. Okay, and let's say fees, just generally speaking, are about 1.5 to 2%. Includes the financial advisor, includes the trustee. That's our role here at Capital Gains Tax Solutions. So let's say we're going to try to earn about 6.5 to 7% to net about 5, generally speaking. Okay. Um, so let's say we earn exactly 7 and net 5, then there's no overage, right? No overage, and they got the 5. And it's a 5% compounding as well. Okay. Now let's imagine we earned 8. So it's one extra point there, right? Well, outside of any additional planning, that 1% at the end of that 10-year term would go to the trustee. Now, our goals and our intention is not to get that upside in that scenario, but to keep it what's called business purpose, because this is a business and you are selling, there's business purpose because you are selling the asset to the trust in exchange for a promissory note, which leads to the next question. Well, who owns the trust? Some people think, oh, I must own this trust like a regular revocable living trust. No, you don't own the trust. The reason you don't own the trust is because if you sold it to yourself, it'd be taxable, right? So the government's money is that 1.5 million. Your money's really the 3.5, but the government says, you know what? If you sell it to a third party trust, we have a third party trustee run it, that's our role. And you work with, the financial advisor to invest the funds and all of those things. Basically, you can build something that you can live off of it, right? But you are the sole creditor, right? So nothing happens until and if it pays you the interest, pays you the principal, less the fees that are happening every single year. So you still have some protections in place, but that's the long short of it. We do have a second structure that the children can be the beneficiaries. This is for large, 10, 20, $30 million exits, and people have huge taxable estates where the children can get the benefit of the upside. So let's imagine someone's listening, I got a $50 million estate, it's all inside of my taxable estate, and they were to sell and use what our 2.0 version, we call it our 2.0, DST 2.0. Now, if they were to use that, we can eliminate the estate tax. Their children can be the beneficiaries, okay? No charity, life insurance, or gifting required. But what's neat is, let's say it performs like, 10 or 20% or whatever, right? Over the course of 10, 20, 30 years on average, we do really great. And the note is only 5%. Well, that excess, the beneficiaries, their children, right, get the remainder, capital gains tax-free and estate tax-free. Although it does depend on when the parents set this thing up and when they die. And the last piece of that is when they receive payments from the 2.0, they're going to be paying some capital gains tax and some ordinary income. That's different than the 1.0 traditional installment sale. So I know it's a lot of information there, but you really got to clarify, like, what are you trying to solve for? Capital gains tax? Yeah. But maybe also estate tax. Okay. So you might have one or two trusts. You wouldn't have any more than two per family. But when between those two, we can do a lot of great planning and a lot of tax efficiency.
I love it. I love it. Because really, we look at the entire financial universe, and there's so many options out there for our clients. If I understand the client's goals really well, it's easy to align up and start stacking up strategy that is going to help them accomplish those goals. And you're outlining a perfect example of that. What are our goals? Is it estate tax? Is it estate planning? Is it just capital gains planning? How do we want to manage this? And once we understand those, now we can start looking at how we're building out the structure.
And can I add to that? Right, I've been really thinking about this and like kind of studying and working with my clients. I was just at a recent conference with 11 of my clients, and we were walking through like what's been meaningful for them, what matters the most to them, right? And kind of getting a feel for what we've been able to unlock with the deferred sales trust. And what I've come to kind of realize in I guess a more clarified way is that what really most people who are listening to this potential podcast, and they're between 50 and 65. They built the business, the real estate. They have substantial 5 to, $25 million net worth, and they're going to be exiting. What they're truly looking for is what's called truly passive income, right? We have this concept of passive income is, financial freedom, right? Is I have my passive income, passive in quotations here, that's paying my living expenses and my lifestyle. But it's really not passive because there's property management, there's toilets, there's trash, there's time, there's energy, there's stress, there's debt, there's regulation, on and on it goes, especially in the states like California, New York, New Jersey, right? And it becoming more and more challenging to own and want to own these things during this stage of life. And so, or even if you're the entrepreneur, you're ready to go to that next chapter, but you're not quite sure how to get on the other side of it to be truly passive. And so, what we have a saying around here that truly passive income is to your impact as compounding interest is to your money. And what I mean by that is they want to be able to free up their time, their energy, their space, and they really want to focus on the impact for their family and their legacy or that next chapter of their entrepreneurial journey. And so a story of this has really captured this. We have a client, Warren and Catherine, they owned multifamily properties for like 25 years. Well, they had kids a little bit later in life. Okay. They had two twin daughters, and they're finding that they have basically from 10 to 18 to spend time with them before the kids are off to college. And they're saying, wow, well, Warren's driving 2 to 3 hours a weekend. By the way, the property's a great property. It's performing. They're multimillionaires, right? And they have good tenants. They're taking care of the tenants. They have some joy in taking care of some of the tenants. But they're saying, what are we really trading? Like, we're not passive as we want to be. We're trading the time and energy with our daughters, but we only have this small window of time here. And we really want to have more impact with them. And so fast forward, they used the deferred sales trust. They went from $120,000 NOI cash flow to over 190. They're coming to these events where we're building out their mission, vision, and values. And we're about to go overseas with them to Uganda to start putting in clean water wells, right? And they're going to bring their daughters with my daughters and our family and their family. And it's going to pay eternal, impact versus just the temporary cash flow. And that's really the mindset that I want to encourage people to think about is like, instead of thinking of ROI, return on my investment, I want you to think of the true ROI, return on
Hmm.
impact, right?
Right.
And what that can mean and do for you and your family.
Yeah, I love this. There's so many things that I want to unpack here. So the first thing is I love what you're talking about. We like this acronym called REACH, okay? And it's the most valuable things in life. The R's for relationships, E's for experiences, A's for advancement or growth, or advancement and growth. C's for contribution. It's better to give than receive. And then H is our health, and that's our spiritual, emotional, and physical health, right? And so you just touched on almost all of those factors, right? I'm going to go spend time with my family, create amazing experiences. We'll learn and grow in that process. We're going to contribute to people's well-being. We're going to make an impact on the planet, and all of that's going to be good for our mental, spiritual, and emotional health. So, our physical health. So that is beautiful. I love the way you're thinking about that, and I appreciate taking this idea of like, let's just move the dollars off the balance sheet and go experience those dollars, right? And get to enjoy those. So that's beautiful. I think another thing I want to tack on is the average real estate investor lasts for about 3 years before all of the things that you just talked about. Real estate is not a passive income source. It is a active income source because it's like owning a small business. I have to spend time, energy, resources going to manage this thing. Now, there are ways to go make some real estate investments that can really be very close to that passive side of things, but it's still not the same as a stock and bond allocation.
Can I
So
add to that real fast? By
please,
the way, thank you so much for sharing that. I love the REACH acronym, right? And I love that you're focused on helping your clients, holistically look at their wealth in all areas of their life and not just the financial side of things, which is important, definitely important, right? But just one of them, we call it the five major wealth categories. Um, Truly passive income, we define it as equaling something like this, right? No debt, no liability, no tenants, no hassles, no lost time. And I don't know if you've ever heard that song, No Shoes, No Shirt, No Problems, right? By Kenny Chesney. I want the listeners to be thinking about that, right? You're Kenny Chesney and you're sitting, on a lake or at the ocean and you have no shoes, no shirt, no problems. Like, and you're playing that guitar and you're living you're at a very a peaceful, intentional, impactful life. And it's not just about retirement, right? That is a part of it, right? That's cool to be out, have that free time. But it's really like, what are the things that are going to give you fulfillment? What are the things that are going to move your legacy in a way that you're going to be a steward of the legacy versus an owner of the assets, right? Stewardship is like eternal, multiple generational focus. Ownership is like, oh, what can I hold on to now? The things that I think are going to give me the temporary stuff. And so it is truly passive income is going to unlock that return on impact. And it's like being like Kenny Chesney. Who doesn't want to be like Kenny Chesney, right?
mhm. I love it. I love it. That's beautiful. So I think there's another. I'm going to get into a technical question now. So if I own real estate, I think the most common capital gains tax deferral strategy is a 1031 exchange. Like, okay, I'm going to take the proceeds from this one and move it into the next deal, right? Now, we've alluded to why that isn't a great idea, but can you talk about how the deferred sales trust is a great 1031 alternative?
Yeah, let's talk about the client, a live, actual deal, a client story,
Hmm.
success story. His name is Peter, okay? And his name is Peter, and Peter actually made a whole YouTube channel. On my YouTube channel, he made a whole video on this. And Peter's driving from Marin, California, and this is where I grew up in Taxifornia, now in Florida, by the way. And so he's faced a lot of taxes. He's driving from Marin to Sacramento, 2 or 3 hours in traffic both ways. and he's trying to take care of these tenants. He 1031 exchange into this property. He's a full-time real estate owner, broker. I mean, he lives and breathes it, right? And now he's approaching 65, and he's finding himself spending more and more time and energy there than he wants to. In fact, at one point, he parks his car, he walks up to the tenant to talk with the tenant, and there's a drive-by, and his car gets sprayed with bullets. And he's like, starts scratching his head and going, I live in Marin. I've got, it's somewhere between, let's say, 2 to 5 million net worth. Where am I doing right now? You know what I mean? Like, this is not what I want anymore in my life. It's not bringing me joy and fulfillment. It's actually putting me in danger. Okay. So I have 18 problems. This is what he told me. And I asked him that exact question. I said, what? I said, Peter, like before we get started, I usually try to really flush out the alternatives for people. I say, Peter, why not just do a 1031 exchange? Why not just do what you've always done? He goes, you know what, Brett? Here's why. Over there is 18 units. He goes, I have 18 problems. He goes, I don't want to have 36 problems. I have 18 problems. I don't need I don't need to double my problems with new toilets, new trash, new liability, new management. And sometimes that's the hardest thing for people. They've been swimming in the, it's like the frog inside of the bucket, right? And they're churning it and they're trying to make it butter, and they're just comfortable there because this is what they know. But sometimes they got to like stop, look around, and say, is this really what I want? And also, what is over there that if I just had a way to get there that would actually be what I want, right? And that's really the heart of this. And so, by the way, does that mean a 1031 exchange can't be what you want? Not at all, right? Like we love 1031 exchanges. In fact, I started my career as a multifamily broker at a place called Marcus and Millichap, helping people do 1031 exchanges. And we love a 1031 when what? When everything lines up. The property makes sense, meaning like you would have bought it regardless of the tax deferral, the location, the time. You find joy and fulfillment in pouring into the tenants, and solving the problems. Having that small business or that large business, like you're finding joy and growth and fulfillment and achievement and teaching your kids how to do all of these kind of things. Like that's an amazing thing to be able to have. We don't want to take that away from you, by the way. The deferred self trust, what's beautiful about it is you can still do that. Like back to Warren and Catherine real fast. The kids can go to college for, they're 18. And by the time they're 25, mom and dad are sitting in the deferred sales trust. They're diversified. They're getting the cash flow. They're living their best life. Then their daughters are like, hey, dad and mom, I want to start a business. I want to buy that property. They're like, awesome. Guess what? The trust can put up the capital to do it. You don't have to go to the bank. You don't have to go to a private equity. You don't have to go to a hard money lender. You can do that all tax deferred. So you can get back into the game. So what we're saying here is, have flexibility for the seasons of your life when wealth is serving to help win those 5 areas of the reach, right? And not subtracting from it, but have the flexibility to go back and forth with that. Like let wealth be the tool you're using, right? Not the compass of where you have to stay.
Right. I love that. And you just highlighted a key point. Like a 1031 exchange has all of these timeline restrictions. Like I've got to identify a property, I've got to buy it within so many days. Like all of these challenges where I could move to deferred sales trust. 5 years from now, I could go, hey, my kids want to buy a property. Cool. Let's reallocate these dollars into the next project. If I heard you correct, would that be a fair statement that
Yeah,
we
let me give you
can?
the real technical real fast, right?
Yep.
No
Yep.
45-day window to identify, no like kind of replacement to identify or to buy. So 45, 180, no debt replacement to replace. That's the biggest one people mostly miss. You have to replace the debt equal greater value, right? You don't have to face a seller who's negotiating. Basically, you're playing blackjack with you or poker with all of your cards out. They're probably not going to give you a great deal. You're probably selling high and buying higher, right? And that's the reality a lot of people are doing. And then you're forced to make these decisions under the gun. And I call it the blockbuster. You get to return the video in 3 days. You have to rewind it versus the Netflix when you can just take your time and go whenever you want, right? And so this is the leverage we want to give back to people. The other one too that people miss is in a 1031 exchange, the whole entity must move. Like we did a $13 million exit for a client. They had 4 partners. Well, they bought it for about 200,000 the land. They built it for about 4 million, the car wash, and they sold it for 13.5 million in California. So for them, they had 4 different partners with different risk tolerances, time horizons, needs, and wants. Well, one person just paid the tax. The other 3 just did a deferred sales trust into their own trust, right? They didn't have to have separate, commingled money. But at 1031 exchange, the whole entity must go to the next deal. And all of a sudden you're like, I was good with this for 2 or 3 years, but I didn't want to do another 3 or 4 years. And so the partnership can be seamlessly separated, which is key. On our scenario, we can get completely out of debt. So we call it the Dave Ramsey debt-free plan for your large commercial real estate or business sale, right? You can be truly diversified. You can go into stocks, bonds, mutual funds, real estate. And we have clients that went into Bitcoin at a low price, which is doing pretty good right now. And you can also be an entrepreneur to go back into your own deal. A 1031 exchange only works for investment real estate. It doesn't work for business sales. It doesn't work for Bitcoin. It doesn't work for publicly traded stock. It doesn't work for primary homes. Guess what the deferred sales trust works for? Everything, all of those, right? And we've done it with all of those, right? So the last word I would say is to the point of the 1031 exchange, they do have a stepped up basis. Okay. So it's important to understand that that is a great thing for people as long as it's still around. We think it will be, but you can't definitely count on that. But at the same time, the deferred sales trust, you can pass it to the kids to step into your shoes, right? So that's just a little bit more context on the compare versus contrast. Now, someone might say, well, Brett, can't I just do a 1031 exchange into a Delaware statutory trust? And the answer is yes, you can. Those are packaged 1031 opportunities that are large corporations that put them together. Here's some of the downsides. One, huge fees. Sometimes 10 to 15% on every dollar is fees. 2, you have no control, no liquidity, no diversification, and you're typically tied up for 7 to 10 years, right? And the returns are typically around 5% cash on cash, right? So that's not necessarily great. Now, these are beautiful properties that are packaged well, but at the same time, like, again, does it really serve what you want, right? Does it really serve what we want? Now, the good news with us is we actually help on all 3 of these: a regular 1031 exchange, Delaware statutory trust, and a deferred sales trust. We're one of the few in the whole country that's actually done all 3. But we find that 95% of our clients are just choosing the deferred sales trust for everything we've talked about. But the other ones do have their place, but it just depends on the fact pattern and what people are trying to accomplish.
Yeah, no, that's so interesting. And we've seen some tenant in common structure where people sold out in 1031 into we'll call it the tick structure that I will say blew up in a way similar that the DST could, the Delaware Statutory Trust could. Like if the person running that project isn't great at it, if and we saw some problems there with people, like you said, they were selling high and buying higher, right? This was in an appreciating market, and they moved into assets that when the market fell off was a problem. And this was 2008, 9, 10. And so when we look at all of those factors, it's like, this looks great on paper, but at the end of the day, I'm still in real estate. I still maybe am buying at very high valuations to recognize my gain in my project. And this the deferred sales trust just offers us so many different options in regards to what kind of asset class I move into and when I move back into real estate if I want to. Uh, yeah, I appreciate that overview. That's fantastic.
Absolutely. I'll add to that too. Some people do these absolute triple net deals, right? Where they go into these Walgreens, or they go into these auto zones, or they go into CVS stores. And the challenge with that too is typically all of the equity is all into one deal in one location and into one business. And you go, really, is that really what you want? No diversification, no liquidity, all tied to this one asset, this one location. And I just go, what are you trying to accomplish? Are you in wealth creation mode versus wealth preservation? And they go, well, I'm in preservation mode. Oh, okay. And I want some creation. And of course, I want some cash flow. But you go, okay, so what makes more sense for preservation? To diversify or to be all in into something that's illiquid? And by the way, if you're putting on debt and the debt expires on the rate lock and now the debt doubles, this is what we're seeing. And people are losing half or all of their wealth. And they built it all up and they've done these 1031 exchanges and they're going to get crushed. And so we say, really, instead of thinking absolute triple net, I want you to think absolute TPI. And absolute TPI is truly passive income, right? And basically, we want to teach everyone who's listening how to unlock TPI by being able to diversify. And diversification is not just asset class, it's also dollar cost averaging on time. It's also the ability to flex with the market, right? T-bills maybe for a few months until you get a roaring stock market, which we're seeing pretty good gains after this election here, right? And and that's a diversification of time, right? And the ability to be nimble and move. Which, by the way, the real estate market is also some good buys now. We're buying some stuff at some discounts now because of all the people who overpaid before. And then what we're going to do is we're going to ride that up. We're going to sell it again, defer the tax again, and then we're going to go back to other things that are a little more conservative. And so just the ability to flex your mind and your expertise within investing and work with people like Patrick unlocks so much truly passive income, and truly passive peace of mind is what I call it.
Yeah, I love it. Now, just geeking out over all of the capital gains tax strategies, I think another one that comes to mind is the charitable remainder trust. Now, I generally have to have some charitable intent to make the economics work out there at all. And just a quick overview of charitable remainder trust is the dollars go into the trust. I receive the income off of that, and then when I pass away, it goes to the charity. Okay, like um, again, pretty cool thing if it aligns perfectly with all of my goals. And I think I've heard you say this before. This is like a charitable remainder trust without the charitable component, right? Like I've got maximum flexibility with this strategy as compared to that one. Because we've had clients try to shove the charitable remainder trust into the solution just because they didn't want to pay the tax, and it doesn't work. So yeah, thoughts on
Yeah,
that?
I'll touch on that. Yeah, so absolutely right. The charitable trust is amazing for times where you are wanting to be basically 100% charitable, is the way we call it, right? With the deferred sales trust, you have the option to be charitable, but you don't have to be. And here's why I think this is so important. Like, as stewards of the capital and the wealth that each of us have earned, and the people listening have earned, right? The last thing we want to do is to give it to a charity that perhaps in 10 or 20 or 15 or 30 or 50 years after we pass away, their values are not aligned with what mom and dad, what we had in mind. And so we believe that the stewardship of giving to charities starts with the family building mission, vision, and values into their children or their brothers and sisters or their nephews, or however, if they don't have kids, in a way in which the charity can be turned on and turned off. So the deferred sales trust really simply can give to charity. That's great. But guess what? If the mission, vision, and values are not aligned anymore, it can be turned off, right? So it's not going to irrevocably transfer the assets at death to the charity. Now, there's also donor advised funds, which are actually much more flexible, which are also, we love those. Actually, those are probably our favorite, but they're not going to solve for the capital gains tax or the estate tax, right? So a combination of like a deferred sales trust and then a donor advised fund, funding it every single year as the payments are made out to you, can create a great flexible impact giving efficiency as well as flexibility for investing. And so you combine those things. Yeah, most folks, once they see the deferred sales trust, they go, yeah, the CRT is really blockbuster. We prefer Netflix.
Yeah. Yeah. No, I love it. Okay. So we've talked about a number of things. There's a few things I want to touch on. So as far as the IRS is concerned, is this somewhere off in the gray, and I'm going to end up in big trouble when the IRS comes looks at the structure that we put together?
No, I'll start with this statement. And this is from the creator of the structure. He's a tax attorney and a CPA. He's my business partner. And basically, he says, look, this is the most vetted tax deferral strategy you've never heard of, is the way we stick it. We usually start with. Okay. And we've had national law firms. We work with CPA firms. We've been through close to over 30 audits, all no change, no findings, formal audits, promoter audits, state level audits. One of the biggest audits was over $120 million asset sale in California. And not only have there been no change, there was no findings. Like this is like a perfect audit track record to date, and it goes back to over 28 years. And there's been thousands of transactions, billions and billions and billions of assets sold using this, and it's batting 1,000, right? So that's the first thing to understand, that we have a perfect track record. Now, there are those who don't want you to know about this, And there are those that don't understand this, and there's those that haven't signed the NDAs, and there are those that have competing structures and strategies like the CRTs and like the 1031 exchanges that they're saying what they have and what they try to do, right? And that's great. Like we think those are blockbuster strategies, and this is Netflix. But be that as it may, we have those that still don't think this thing works, and you're going, okay, well, we keep closing them, we keep passing all the audits, and so this is not something you're going to find in the IRS tax code. This is not something that is on a watch list. It's never been on a watch list. It's never been on a dirty dozen list. This is not a reportable transaction. Like it's all of that is completely clear and clean. It's great. And the reality is, it's because it's a 100-plus-year-old tax code called IRC 453 for most of these sales. And this is a seller carryback. Like when you say, like, oh, we know that, we just figured out how to do that with a third-party trust and a third-party trustee. That's our company here, Capital Gains Tax Solutions. And that's really the key. It's like, as if you're a chef, making something that's extraordinary, everyone has the same ingredients. The question is, what order do you put them in and how do you execute it? And that's what we've been figuring. We've perfected that. We perfected the way to make the outcome of this still stay within the conservative guardrails of the tax code, and also how to present it to the IRS to show them what we're doing.
I love it. This is great. So we've talked about all of the fantastic benefits of the deferred sales trust. Now, with, I'll say, any strategy, there's generally some strings involved, right? Like, I think the clear string is I can't just take all my capital and use it any way I want, right? I can't go buy the boat without paying the tax. So can you talk to us a little bit about what are some of the downsides, some of the reasons why somebody would consider not doing the deferred sales trust?
Yeah, what's the catch here, right? And we just talked about the legal one. Like some people, it's seems too good to be true. I haven't heard about it. Is it legal? Am I going to have to report it? Am I going to be audited? All that stuff. By the way, all these audits were no trigger audits too. It's a very low audit risk. So that's the first one. So also, there's lifetime audit defense provided as a part of the structure. No additional cost for that lifetime audit defense for the deferred sales trust. So you're covered there. So let's just assume you guys feel great about the legal part. Awesome, right? By the way, bring on your CPA, bring on your attorney, your broker, bring on all the people. We educate them. They sign the NDAs, okay? And we have a very high close ratio with those folks as well. And they start sending us referrals. So if you're a CPA or a real estate agent, financial advisor, broker listening to this, please, we encourage you to come and to do your due diligence. We work on a no cost, no obligation basis where we will walk you through your transaction. Needs to be a live deal. And with NDA signed, we'll work through it. Okay. But we're not here to like give our secrets away just because someone signs an NDA. Okay. That being said, that's the legal part. The next thing that people have to, I think really get comfortable with is understanding that they are giving up control, right? Are they giving up all controls? No, but they are giving up control because they don't own the trust. The trust owes them the money. They're becoming a lender. They're becoming a bank is a good way to think about it. But is a bank concerned, Patrick, if you don't pay your home, if you have a mortgage on your house, are they concerned that they can't just foreclose and take the asset? No, they're going to foreclose and take the asset if you don't pay. So as a lender to the trust, you have all the rights and protections of a bank. You also have to approve of the collateral. So nothing loses without your approval or your signature. Okay. Right. And then what can we secure it against? Well, Patrick will probably put together some of the biggest companies in the world, a diversified portfolio that you approve. Now, the trustee, that's my role, our company, we have to approve it as well. So that's some of the control piece. Right. But to be honest, my approach to this business is a real estate investment advisor to balance out the wealth team with the financial advisors that are focused on the securities mostly, right? Stocks, bonds, mutual funds, insurance. Or I'm in the real estate aspect, and we build this kind of dream team. So I become an asset to the team, and not a subtractor to say no. So my odds of me saying no are like 1 in a million. But if I didn't have that one chance to say no, then the trust would not be legitimate. Okay. So this is a control piece. By the way, funds are typically like a Charles Schwab or wherever you're clear at, right? And then funds, you 24/7 access to view the funds online. We also have third-party tax preparers and do the P&Ls and do the full trust tax return. You get access to see them and be a part of all of that. So everything is transparent, everything is shared. You get to see everything and be a part of all of it. Okay. Number two, the last one is fees, right? So Brett, how do we make sense of this 1.5 to 2% of the fees on an ongoing basis? Well, Patrick might charge 1% on $1 million or 1.5 on $1 million. On $5 million, he might charge 1 or 1.25. Might be a little bit lower. At the end of the day, we like to say how to make the DST an investment and not an expense. And that's number one, through tax deferral on the capital gains tax. But number two, when people miss sometimes is the income tax deferral. you might sell that $5 million asset and have a 5% earnings, but you may only take 125,000 out. You may only take a partial interest and let the other 125 accrue and earn, right? And so you can defer the income tax too for a period of time. We like to say about 2 years at least, but you also don't have to take the full interest payment out. So we might have a note at 6, 7, 8, or 9%, and you might take a 5% payout and let the other amount accrue. So you have some income tax deferral. One fee I do want to mention is the one-time legal fee. That's upfront. That's based upon the gross sales price, 1.5% on the first million, 1.25 on anything above that. So keep that in mind as you're looking through this ROI, which leads to the next piece of the ROI, which is the ability to partner with the trust to form a new LLC and buy investment real estate or buy a business, which establishes a brand new depreciation schedule. And this is huge. We call this tax flow depreciation, right? You want to increase your tax flow depreciation to offset your cash flow. Okay. And so picture this, you own Bitcoin right now, and it's almost 100,000 a coin. And let's say you have 10 million of it and you have a very low basis. Well, guess what? Bitcoin you cannot depreciate, or you own Nvidia stock, right? Or you own, something like an apartment complex that's fully depreciated. Well, you could sell, defer the tax, get a note, let's say for, let's call it 8% on 10 million, 800,000. And you can partner with the trust into a new LLC, and that trust could buy, let's say it puts 5 million down on a $15 million apartment complex. Now you get a full depreciation schedule on that 15 million, about 80% the way we structure it on that LLC to keep it commercially reasonable. But this is so all of a sudden you say, wow, this is an investment and not an expense. And once you overcome the legal part, you overcome the controls in the trustee, giving them some controls, and you overcome how to make the DST an investment not an expense. We call it the big domino falls over, and people are like, oh, we're all in and we're ready to go. Here's the key though, to qualify, you need to have $1 million net proceeds, $1 million gain on the transaction. Means it needs to be big enough. Okay. So if you're saying, Brett, I've only got 250 or 300 or 200, it's too small. One exception, if you have two assets that you're exiting that have 500,000 each, you can combine it into one trust and you can make it work, right? But we need to have at least $1 million gain between those two and $1 million net proceeds. That's our minimum to make this thing really make sense.
I love it. So, Brett, one of the things that you just mentioned, I've got a meeting this afternoon with a client they're looking at selling their current space that their businesses run out of, and they want to build a new space. And they were like, can we 1031 into that new opportunity? And I was like, maybe. But part of the problem, there's more some nuance to it. But I'm like, this might be the best option to sell into the DST and then sort of restart all of the depreciation and all of those other factors that, because they like all of the tax benefits that comes along with owning the real estate. And this would be a fantastic opportunity to, run a new cost segregation study and sort of reboot all of those things out of basis that we lose when we do the 1031. So
let me get some context in case, make sure everyone is catching what you're saying, Patrick. Okay. So in a 1031 exchange, the old depreciation schedule travels. Okay. So that's not good, right? Because if you have less depreciation, that means you have less write-off. Okay. So what Patrick is referring to is if his client, let's just imagine they have a $5 million building, has zero depreciation left. If they were to sell that and buy another $5 million property exactly, guess what? They have no depreciation. Now, if they were to sell that $5 million property to the trust in exchange for a promissory note, and then turn around and have the trust partner with them into a new LLC, put up the down payment, buy that same property, it's a fresh depreciation schedule. So we call this, I guess DST, ninja work right here, right? So we're getting into like the really nitty gritty, but that is the reality. And so you got to look at your numbers and look at this thing and go, man, like, this makes a lot of sense to me. If it does, we're happy to help.
yeah, this is beautiful. And I think one last thing, when we are looking at strategies for our clients, we're always comparing the setup costs to the tax, setup and ongoing administration. And we just consider like those fees and the tax, they're an expense, right? Like period. And I look at the expenses here, they're actually not very high at all compared to the tax and the ongoing setup. We see some strategies that have 60, $70,000 a year at administrative costs to just keep them all running, and that's sort of a fixed fee. So it's like if you put $500,000 in or $10 million in, your number's there, and it's like this strategy. I love how it's percentage based, and really the performance is going to soak up a lot of that fee,
Yeah,
especially
100%.
when you're
So
considering.
we also
Yeah,
cash flow our fees, right? So meaning like if something closes at 10 million, let's say that, let's use a million to keep it simple. Let's say it's a million, it's 15 to $20,000 for that first year fee, right? On our side, and let's say that includes you, Patrick, right? For whatever percentage you have. On our side, we would cash flow our fee. We'd wait about 60 days before we collect. And so the principal comes in. The tax attorney takes the one-time fee, but our goal is to not eat up that principal. And essentially, like most of our clients, they say a win-win when they can look up after 10 years to leave off the monthly payment that they were looking to achieve after fees. We still have the original amount in. Like that's like a huge win. They're like, wow, this is great. Using compound interest in our favor. It's an interest-free loan from the government at zero interest on the amount that's deferred until you take the principal payment. And that's it. We're just using compound interest. We call it unlocking the eighth wonder in the world when you exit. And we want to help you have the TPI. I can give some action steps too. People might be wondering, like, what do I do now? Do you mind if I just take a couple minutes talking about what to do?
that'd be great. That's
Okay.
exactly where I was going next. So let's do
So,
this.
so number one, we want to encourage you, Patrick and I, to reevaluate your rental properties at least once a year. Okay, and it could be your rental properties, it could be your Bitcoin, it could be your primary home, it could be your business. Like basically reevaluate those properties. And here's what a couple questions I want you to ask yourself: calculate the return on equity. The return on equity. Okay, what is return on equity? It's pretty simple. Like whatever your cash flow is, and you got to also consider what the appreciation might be as well. Um, and basically what the value of it if you were to sell today and kind of calculate that and then you divide that, it's going to give you a return on equity amount. A lot of clients, they're like at 3 or 4%, which is pretty low, pretty low. In fact, the client that I worked up in Placerville in Sacramento, their return on equity was about that 3 or 4%. And then we immediately increased their cash on cash return by about 65%, right? And so all of a sudden their ROE goes through the roof, right? Plus, we get to do the return on deferral of income tax because they lived in California and they're not taking the full payment at least for a couple of years. So they're deferring all of that income tax. I even had one client, we sold an $8 million property in Palo Alto. He moved to Nevada, established residency, and as he receives payments, it's just non-Nevada, right? For the interest, not the principal. Okay. So calculate your return on equity, calculate your cash on cash return, and make sure you, even though you love that property or that business, like, are you maximizing what you could be if you were able to earn, let's say, 7, 8, 9% on average per year with working with Patrick or I on this? Okay. Number three, determine what it's producing, right? And also your return on your time, right? So your ROT. So how much time and energy is it taking you to make all of that? And what happens if you could free up that time and energy and have the passive income increase, truly passive income? Maybe you want to go start something else. That's cool. And you can make even more over there, right? So you've got to be evaluating these things. And the last thing is take action, right? You hear a lot of this information, you're digesting a lot. We want you to take action. We want you to get the book. It's called Building a Capital Gains Tax Exit Plan. And it breaks down my story of learning how to do this from basically working side hustles to keep the lights on when I was a brand new real estate agent, to the first baby at home, living with my brother in a small condo, to learning about this strategy and helping my clients who are also struggling with losing half or all of their wealth in the 2008 crash. And then landing on this strategy, going all in and sharing our secrets. We want to share our secrets, speed up your time to where you want to be by leveraging this information and our strategy. So that's it. You can find me at capitalgainstaxsolutions.com. You can check out our YouTube channel, our book on Amazon, Building a Capital Gains Tax Exit Plan, and also brettswarts.com to get kind of the whole ecosystem of what I'm doing.
I love it. And for those that are driving, listening to this, can't write it down, we will have all of that information in the show notes so you can go find all the resources Brett was just talking about. So, Brett, this is amazing. I feel like we've just scratched the surface on the opportunities here. I think Bitcoin is another opportunity. I think there's uh, lots of different ways that we can look at this, and I'm excited about that. So, thank you very much for joining us here today. This has been a pleasure. I love how our our thought process is aligned with the most valuable things in life aren't a big bank account. It's some of these intangible things. So I just appreciate all of your wisdom and guidance.
Thanks. It was my pleasure. Thanks for having me.
Thanks a lot, Brett. Bye-bye. As we wrap up today's episode, I want to leave you with a valuable opportunity. As we're getting our year-end tax strategies implemented for our clients, we wanted to give you the tools you need to save big money on taxes this year. To access the resources that can help you create a tax strategy, head over to vitalstrategies.com/cornerstones. We'll give you free access to tools that our clients have paid tens of thousands of dollars for us to implement. These tools are designed to help you pay less tax, build more wealth, and live a great life. Again, that's vitalstrategies.com/cornerstones. Remember, your dollars are better off in your hands than the government's. Thank you for listening and for being a vital entrepreneur. You're vital because you are the backbone of our economy, creating opportunities for your employees and driving growth. You're vital to your family, fostering abundance in all aspects of life. And you're vital to me because you strive to build wealth, make an impact through your business, and live a great life. Until next time, I'm Patrick Lonergan, and thank you for listening to the Vital Wealth Strategies podcast.